If you see the charts, Mapletree Industrial Trust, minus 21%. Keppel DC REIT, minus 30%. Digital Core REIT, minus 50%. Wow. And if you look at it closely, you realize that a lot of the drop came after August 2022, correct? And that's all because of interest rates, going up. REITs, will they lose money? There's a lot of serious fear on interest rates and REITs. One example can be seen over here. Will dividend drop by 40%? How about if Fed raises rates to 9%? Some REITs may even default on their loans and let alone be able to still pay dividends. Now in today's tutorial, I'll be debunking some of these concerns, and if you are interested to invest in your data centers, I think this tutorial is for you. Hi guys, welcome back. As we all know, interest rates have been climbing up, correct? If you see fixed deposit rates going up, that's because US Fed has raised Fed fund rates all the way from, a very meager 0.something% all the way now to 4%. The reason is quite obvious, because inflation is running rampant all over the world, correct? And let's start with US first. This chart actually shows how things have spiraled out of control. Headline inflation rates are now above 8% plus. Headline has food and energy within its components, so that's why it's a bit more volatile. Core inflation, that has been even higher than 6%. So if you compare US and Singapore, you realize that Singapore is slightly better because November core inflation came in at 5.3%. And you realize that different places of the world are experiencing different inflation rate. But nonetheless, the overall climate is roughly the same. So the first question is, does Fed need to raise interest rates to be 8% to tame inflation at 8% or not? I think let's answer that question once and for all. If you see what analysts have been projecting, they've mentioned that the median projection for Fed in 2023 is about 4.5 to 4.75% only, correct? That's little more than 1% from where we are as of today. Currently, Fed rates are 3.7 to 4%. And that's only 1% more, which is 100 basis points. So definitely 20% Fed rates are out of question. Even 8% seems extremely unlikely. So if this has been useful information, please smash the like button early, because the next part I'll be showing you details of Mapletree Industrial Trust and Keppel DC REIT, whereby you'd see that they've actually given some numbers to quantify that risk. And as always, I've done the homework. Smash the like, smash the subscribe, and stay tuned for more good content. So let's address how much impact is going to be for Keppel DC REIT first. When it comes to REITs, the biggest concern is interest rates go up, the interest cost would go up. That's true, but I think a lot of it is exaggerated already. 40% dividend cut or even a default on loan, I think that's out of the question. Because what has been mentioned by Keppel DC REIT specifically is that if 100 basis points increment, that will cause a 2.1% negative impact on the DPU. 2.1%, not 40%. But in any case, this is results from 30th September, which means the interest rate back then is slightly lower. So let's put 200 basis point increment, which means what we can guess for 2023 for Keppel DC REIT, if you're a shareholder, is that the DPU could be impacted by 4.2%, 2 times that initial amount. So it is true. And when we look in terms of borrowings of REITs, right, how this impact comes about can be from two factors. First is that when are the loans maturing? For Keppel DC REIT, you can actually see that a large part of it comes in 2023, correct? Actually, it's not so big also. It's just 11%. I've seen other REITs, and this is still very manageable. 2024 actually dips quite a bit further. They've actually planned well, and a lot of their loans are only maturing from 2026 onwards only. That's one part. Maturity, when are the loans going to be due? The second part is how much fixed rates have they decided to use in terms of their overall debt management portfolio. You'll see that for Keppel DC REIT, the fixed rates are also quite high. They have stipulated over here 74% is fixed. Across all REITs, I think this is about average or slightly better than average. So if I'm a shareholder of Keppel DC REIT, I'm not concerned at all. In any case, I'm not a Keppel DC REIT shareholder. I am a Mapletree Industrial Trust shareholder. So let's dive on to the debt maturity profile. You see that Mapletree Industrial has a bit more maturing this year, 11.9%, correct? So they're actually doing refinancing, in my opinion. And if your question has always been, hey, how come REITs cannot pay off these loans? Because if you see Mapletree Industrial Trust, they only have $165 million, correct? But their total debt maturing is way bigger. And that's definitely not enough to fully pay off the loan, which is $351 million. So what they do is they typically refinance, so they don't pay off loans. The good part about Mapletree Industrial is that for 2023 and 2024, the amounts maturing then are pretty small. So for Mapletree Industrial Trust, what is the impact going to be? They've actually done a disclosure or a simulation. For interest rates rising by 200 basis points, the total impact on DPU, as I've boxed out over there, is only 3.1%. Again, it's not a 40% drop in dividends, 3.1%. Nonetheless, still an impact, but a small impact. But take note again, this rate that they are disclosing is also evolving. Come 2023, as things mature along the way, you realize that the impact also changes. So it's not a fixed amount. We need to continuously track things. But when I highlight this, it's meant to tell you it's possibly an opportunity. If the fears are over-exaggerated, the sell down is too steep, then you could be buying REITs possibly at a discount. Coming to here, maybe you are still not convinced. You still feel that if interest rates have to go up, REITs confirm need to come crashing down. Then let me show you a very interesting chart back in 2018. What do you realize back at that point of time? I've actually mapped out for you share price movement in 2018 versus Fed fund rates. You realize that 2016 all the way to 2019 was a Fed raising rate cycle, correct? Rates were climbing from 0.5% all the way to 2+%. And in that cycle, you also realize that the REIT share price, or rather in particular Mapletree Industrial Trust and Keppel DC REIT, were climbing quite aggressively. While that cycle is a bit different from this very abrupt rate hike cycle, it is also proof that interest rates going up is not the end of the world for REIT share price performance. There are more factors to things. And that's what I'd like to try to explain looking deeper into the books. So for Mapletree Industrial Trust, I'm actually a shareholder and I'd like to share with you some of my analysis. You see over here for the latest statement for second quarter 2022, you realize that borrowing cost has jumped up quite a lot, correct? Up by 36.6%. The reason also is because the previous year, the starting point is so low. So this jump should moderate also coming to next year, and that's what I'll be tracking and sharing with you on this channel. And while the borrowing cost has jumped up by $6 million in total, you realize that the amount available for distribution has actually still managed to increase, correct? So it's pretty good. They've managed to get more rent from their properties. So that's not an issue. But the DPU has, on the other hand, dropped, correct, from 3.47 to 3.36. So you'll be asking, what is the reason for things? They've actually done a disclosure. They've actually a 6.6 million tax exempt income. They will be deciding to space it out over the next 3 quarters. And what's the use of it? I can't be sure. So I'd rather they give it back to me as a shareholder straight away. But they've decided to take that step and cut DPU. I'll touch on the green box in a while, but let me share a few rounding points first. The key part about interest rates and REITs, in my opinion, has run for quite a long course already. My biggest worry now is operational performance more than interest rate costs, because that has been factored in for quite a long while. What is operational risk? We can see over here that many tech players are laying off staff already. Twitter, Meta, Lyft, just to name a few. And could this layoff in tech sector also mean that certain tech firms could close shop in 2023, which also impacts the demand that companies would want in data centers, because tech is the biggest consumer of data center services, correct? And let's pull back again the Mapletree Industrial key highlights. You realize that average occupancy of their North American portfolio has fell from 94% to 93.1% due to a non-renewal of lease by a tenant. Now this is a loss. Hopefully it's just a one-off. Hopefully it's not the tip of the iceberg. If it is, then operational performance could deteriorate. That is the biggest risk when we own data centers. That's something I shared also in a previous tutorial, whereby I mentioned that Jim Chanos is actually shorting on data center REITs. Check that out. I'll also leave it towards the end of this tutorial. Now, what about Keppel DC REIT? You see that their portfolio occupancy, on the other hand, has increased over the previous quarters. Right now, it stands at 98.6%. Fantastic. Long portfolio WALE, 8.7 years. That also means that a lot of their lease has been locked in for super long term. So if you're a shareholder, you can sleep well on it. But I also like to highlight certain differences between Mapletree Industrial Trust and Keppel DC REIT. Keppel DC REIT does a lot of co-location businesses. You can see like sub-renting smaller units kind of thing, whereby the tenant profile will change quite a bit. And the WALE, which is the weighted average lease expiry for that business, is only at 2.6 years. So if economic crunch hits, I think co-location business could be the one that's most impacted, because technically that is the smaller players in the tech sector. So an example of what can happen actually is this that's been completed many months ago. Keppel DC is taking one of their tenants, DXC, which is actually a small listed company also, for failure to pay on co-location services. So there are risks also, and there are opportunities. So whether you view one or the other really depends on your investment acumen. With that, I'd like to do a quick shout out to my event, Georgetown Finance Summit. This will be held on the 3rd of December, so it's coming in a few weeks' time, correct? So let me invite you there. If you'd like to do a one-to-one meetup and hear a bit deeper on opportunities and risk in the market, as well as what you can benefit moving forward in terms of avoiding certain mistakes and saving money, this summit is definitely for you. This will be held in SMU School of Economics in a lecture room, so there'll be no sales. It's fully an educational summit. And with that, you'll get a copy straight away of my ebook, How to $1 Million, the edition 2022, just by signing up today. From the last shout out, first 15 seats are already sold. Latest as of 17 November, the next 15 almost already sold. So $47 only, simply invest $1,000 in Mapletree Industrial Trust. You get back in dividends already, right? So you won't regret it. Look for links below and I'd like to see you there. So since you start with me to here, let me round things off. When we do REIT investment, I understand the sentiment is quite negative right now. I'd like to encourage you to think about the future. What if indeed Fed funds rate only climbed to 5% for 2023 and inflation finally starts to see subsiding factors? Then will current yield that data center REITs are providing, which is around 6%, be okay? That's one. Not just that also. What if 5% is actually the peak of Fed funds rates, and against all market expectations, they actually come down a bit slightly in 2024? What would that deliver to sentiment in REITs? Take care as always, invest safe, and check out my previous tutorials. With that, I'll sign off from here. Goodbye.